Hi, I'm Jimmy. In this video, we're looking at how interest rates affect the economy and how changes in interest rates can affect things for investors. And then ideally, we can use this information to help us get closer to our personal goal of achieving financial freedom. Okay, so just a few days ago, the Federal Reserve lowered interest rates with a surprise 50 basis point cut. That's the same as 0.5%. Now, this video isn't exclusively tied to that particular cut. This video is more designed for us to get a better understanding of what happens in general when the Federal Reserve lowers interest rates, or if they raise interest rates, well, the opposite would happen. Okay, so this is a one-year chart of the Fed funds target rate. And clearly, the 50 basis point rate cut from just a few days ago, well, that was not only bigger than all the other cuts this year, but it was also a bit of a surprise from a timing perspective. And impressively, the stock market was down almost 800 points on the day that they announced this rate cut, despite the fact that, generally speaking, interest rate cuts are designed to spur the economy higher. Now, the reasons behind this particular rate cut are slightly less important for the case of this video. Instead, let's focus on how this rate cut is intended to help the economy. Okay, now first, and probably most obvious, is that lower interest rates affect the cost of borrowing money. It makes money easier to borrow for people and businesses. So if we're considering buying a house, well, maybe lower interest rates are exactly what we need for us to buy today, because lower interest rates would mean a lower mortgage and a lower cost of borrowing in general. Same thing if we're going to buy a car or any really big purchase. Sometimes lower interest rates can help sway individuals that were perhaps on the fence before. And the same can be said for businesses. If businesses are looking to expand their business or upgrade equipment or maybe make a new acquisition or possibly expand into a new market, well, sometimes lower interest rates can give them access to the capital that they need to do those things, or perhaps the financing necessary to buy new machines or whatever it might be. And in theory, those actions today help spur the economy forward, since more people and more businesses are spending more money. And this is often a very popular technique. If an economy is in a recession, it's a very popular technique to turn the economy out of the recession. It's a good way to start getting more people and companies to spend again. And in theory, that should lead them out of a recession. Or in the case of today's economy, hopefully prevent a recession, or at least keep it further away than it is right now. Okay, so that's simple enough. But now there's another effect we should consider. So many investors are global investors. And when interest rates fall in the United States, well, global investors, and it doesn't really matter where they live, well, now they have the choice. Do they invest in the US, which is dollar-denominated investments, or maybe they decide to invest in something that's tied to the euro or the won or whatever it is. Point being that lower interest rates can often lead to a lower currency value. To illustrate that, this is a 5-year chart of DXY, which is the dollar index, or one of the dollar indexes, and the 10-year treasury. And roughly speaking, we can see that oftentimes when interest rates go down, well, the dollar goes down. When interest rates go up, the dollar goes up. And we can see that this relationship doesn't completely hold true all the times. And that's largely due to the fact that a currency's value is relative to other currencies. So other central banks and other countries' interest rates play a role in this as well. But roughly speaking, a common reaction to lower interest rates is a weaker currency. So that's something we should be aware of. Our next question is, what performs well with a weaker US dollar? Well, oftentimes, gold is a strong beneficiary of a weaker dollar. To illustrate, let's jump back to the Great Recession. And here we can see that during the Great Recession, when the dollar dropped, well, the US dollar would drop and gold would rise. Now, again, it didn't always work this way. In fact, the International Monetary Fund, you might hear it called the IMF, well, they estimate that about a half of the movement of the price of gold can be explained by the movement in the US dollar. So perhaps gold is a good hedge as interest rates are dropping, and also as investors are fearing a pending recession or a further stock market crash, gold could be a good one to offset it. This seems to be well positioned at this particular time. Now, another thing that's happening as a result of falling interest rates is that bond prices move higher. So we know that over the past year, the Fed funds rate has been falling. But then if we switch this to TLT, which tracks US Treasuries that have a maturity of more than 20 years, I believe. And we can see that the price of of those bonds has consistently risen. And then if we switch from Treasuries over to AAA corporate bonds, well, we can see that AAA corporate bonds are once again doing the very same thing. And this makes sense if we think about it. Since interest rates are falling, well, bond prices would be rising since the two are inversely related. So as interest rates go one way, bond prices will go the other way. Well, then perhaps we should allocate more of our capital towards bonds, particularly some of the more secure bonds. Now, maybe we have no idea which way interest rates are going to go. Not many people do. But one thing we can do is watch inflation, since often lower interest rates and the subsequent pickup in the economy can lead to higher inflation. Higher inflation can lead to trouble for the economy, and the Federal Reserve will usually jump in and start increasing rates to try to get inflation under control, and the whole thing sort of swings in that way over the long run. So if we're curious, this is what inflation has looked like since the year 2000. And right now it's sitting at about 2.5%, which is a little bit on the high end, but it's not that high. Now, that's also as of the end of January. February's numbers come out in the next week or two. So 2.5% CPI, just so we're all on the same page. What a 2.5% CPI tells us is that as of the end of January, products, broadly speaking, are 2.5% higher than they were 1 year ago. So if inflation were to start moving higher in a meaningful way, call it 3.5%, 4%, well, it's possible that the Federal Reserve jumps in and tries to slow down the rise of inflation by spinning interest rates the other way and moving them higher. Now, if on the flip side they stay low, well, like we said, investments like gold or bonds could look good. So I think for now, I think it makes sense for us to stay a bit more defensive. And then this brings us to stocks. So broadly speaking, lower interest rates should imply a lower required rate of return. I've discussed that in some recent videos. But that's not the only reason why interest rates should do better for the economy, for at least for the stock market. Because of the whole spur in spending that I mentioned a few moments ago, well, that spur in spending is likely to lead to higher revenue for companies, higher profit margins for companies, and overall the stock market should continue to move higher. Now, I would caution us from not overreacting to any one day or 1 month or 1 quarter or one piece of news. A good example of that is the start of this video. I said I was surprised that the Fed cut rates by 50 basis points, and I was surprised the stock market was down that day. That's a good example of what not to do. That's way too short-sighted. What I think makes the most sense is for us to make adjustments to our investment portfolios based on the big picture trends that we're seeing. It seems to me that what the Federal Reserve is doing is they're trying to kick the can down the road. And because of that, the stock market could resume higher over the next year or two. And that being said, I think it could make a lot of sense to stay invested in the stock market. Now, about a year ago, I did a video called, "Can the Stock Market Keep Moving Higher?" And I referenced Warren Buffett saying that he thought that stocks could keep going up. And that was very much at that time tied to falling interest rates. And once again, we're in a very similar position, except this time they're falling even faster than they were originally expected to back then. So if you're curious, that could be a good next video for you to watch if you're curious about how far interest rates can go about affecting stocks. There's a link right here and there's a link in the description below. And I really want to thank you for sticking with me all the way to the video. I really appreciate it. Thanks, and I'll see you in the next video.